Welcome to our High Rock monthly video. I'm Scott Tomlinson, and with me today is my colleague and partner and the founder of High Rock, Paul Tepsich, as well as High Rock certified financial planning professional, Bianca Tomlinson. I know this part is a bit repetitive from month to month, but I just want to remind everybody that, as you all know, we have three investment models from which we apportion an allocation percent to each client portfolio, based specifically on our respective goals and the time horizon required to achieve those goals. Our tolerance for the risk and potential for volatility that we may have to endure in achieving our goals. Sometimes we think we have more tolerance for risk than we actually do, but it is an important conversation, and we use our semi-annual reviews to continue that ongoing discussion with you. Our well forecasts are intended to capture our long-term goals in a plan that then becomes the basis for our respective investing strategies. So we always stress the longer-term outlook for your time horizons. And although we do have to report your portfolio performance through each quarter of the year, we remind you that these reports are simply a snapshot in time. Just part of that journey that ultimately takes us to our end goals. Now, September gave us improved portfolio performance, and the third quarter ended on a good note, but as we started October, volatility shot higher in stock markets, and if, as we suspect, the last quarter of the year patterns similarly to what happened last year, we should all be prepared for the potential for some further short-term portfolio value dips before we finish with this economic cycle. But again, it is the long term on which we remain focused, and the short-term volatility will likely bring us some opportunity. We always manage risk first, because why would we want to take more risk than is necessary to reach our long-term goals, and by doing so potentially put those goals in jeopardy? And as you know, we focus on the return per unit of risk taken as a key metric in the management of our portfolios. Why do we manage risk first? Well, we know that we have to take risks. Most of our clients, including ourselves, need to get somewhere between a 5 and 6% annual return over multiple year periods before fees and taxes to meet those long-term goals that I talked about. With inflation eroding purchasing power at a 2.5% annual pace, obviously we need to at least be better than that. Now, unfortunately, the risk-free rate of return currently sits somewhere in the vicinity of 1.6%. So if we do not take risk, we would fall behind our annual cost of living increase, and this may weigh heavily on achieving our financial goals. So as I said, we do have to take risk. But as you all know, we have been rather skeptical of the nature of the pricing in equity markets for some time, as we believe fundamental value is being artificially influenced by technical factors and not supported by fundamental factors like earnings, what's going on in the economy, or the global political uncertainty. Volatility over the last couple of years confirms our theory. Global equity markets have provided little return to our portfolio since the beginning of 2018, which has made it difficult to get increases in capital value that is necessarily for some of the portfolio growth. Now, earnings and expected earnings play a key role in stock market price discovery, and as a result of the current economic uncertainty, expected earnings growth is weighing heavily on stock market prices. As you can see, expected earnings growth going forward, at least for the next few quarters, is expected to be flat. Now, all of this is, of course, going to be contingent on what happens through 2020 and how the economy fares. Well, consumers are growing concerned about their employment prospects, and the latest data are pointing to consumers postponing large purchases. But that comes into play in the manufacturing sector, because manufacturers are anticipating a less robust environment, and in fact, the U.S. Purchasing Managers Index slipped below 50 recently, and that indicates a contraction in the manufacturing sector, which can and has historically led to recessions. It's happening in Germany, or it has been happening in Germany through most of this year. It started in January to see that contraction, and it's certainly been happening in Japan as well. Well, bond markets have been strong as we've been anticipating economic slowing, and yields are falling with prices rising. Paul, perhaps this is a good place to talk about our fixed income model and its relative performance when you look at the benchmark.
Yeah, Scott, this doesn't really break it down, but it's, as you can see, XBB, which is the Canadian bond universe, that includes largely Government of Canada bonds, but also CMHC bonds, provincial bonds, municipal bonds, some investment grade corporate bonds, very, very few higher rated high yield bonds. So it's the whole smattering, but really that strength of up almost 10% over the past year has largely come through Government of Canada bonds. As interest rates have gone down, the prices of those bonds have gone up, and I think it would be a safe statement to make that is the move in interest rates lower globally, but obviously as we're looking at now in Canada, has surpassed even the most bullish predictions. And we definitely own some Government of Canada bonds and some investment grade bonds, which also trade with a very high correlation to government bonds. But our entire portfolio obviously wasn't in those securities. But that is just an enormous return or movement in those securities. And I think maybe we'll look at another chart or two, Scott, when we look at interest rates, and I'll make another comment then.
Yeah. So just so our clients understand, we do tend to focus on trying to drive income generation in our fixed income portfolio, and that is why we have perhaps a larger weighting of the higher yielding securities in there. Let's talk about the yield curve, Paul.
There we go. So what we're looking at now is just over the past quarter, from the end of the second quarter in June, on the far left in white, to the end of September, the third quarter. So the top line is the U.S. yield curve. It goes from 1 month all the way out to 30 years. The dotted line is what it was. That was the shape of the curve and the level of the curve back in June. And the dark green line was on Monday, 2 days ago, September 30th. So the key things to note here are, number one, the shape of the yield curve didn't change a ton. But what did happen was interest rates rallied, as we just said on the previous chart or table, a lot. And you can see that in the bottom portion of this chart, and that the numbers there are -20, -30, -40 are basis points, or 1/10 of a percent, 1/100th actually. These are big moves. They're huge moves. And I guess, Scott, what we do at High Rock, we ask ourselves, why are interest rates rallying so much? Why are government bond yields in Europe and Japan negative? You know, the 10-year yield on a German Bund, their government bond, is about -70 basis points, and it was at a -0.75. So -0.75%, enormous. So you're paying the government of Germany to hold your money for 10 years. Switzerland's at -0.85. So you have to pay attention, and we do, as to what the shape of the yield curve is telling us, but more importantly, what the outright level of interest rates is telling us. And it is the number one thing it's telling us, you'll see it in our client note coming to all of our clients shortly, is economic weakness. And people now, the last 2 days, our clients will note Tuesday, October 1st and Wednesday, October 2nd today, as we record, the U.S. stock markets and global markets have been hit very hard. And some of that on these purchasing manager indexes that effectively tell us that we are going into recession, certainly in Europe. And the fear is building that that may be happening in North America as well.
And the reason that bonds, certainly in Europe, are going into negative territories is the safety of government security that investors want to have through this recessionary time, right?
Yeah, it's probably, and we read about this, but it's probably not a lot different than gold. If you own gold bars and you go to the bank, you rent a safety deposit box and put your gold bars in it, you pay the bank every month a fee to store your store of value, to store your securities, your gold bars. And in Germany, Switzerland, all through Europe, you're doing the same. You're saying to the government of Germany or Switzerland, I'll give you my money, store it for me, keep it safe, and keep it liquid. When I want to get it back, I want to sell the bonds. And governments, the reason being is governments have taxing authority or taxing ability. So they can always go raise capital through taxes. Corporations do not have that luxury. So that's the difference between the liquidity and safety of government bond and why they pay you so little, and in some cases they charge you for that safety, versus a corporate bond that has credit risk and does not have taxing authority.
Back to the U.S. yield curve, and we know that central banks on a global scale have been easing their monetary policies, dropping short-term rates, basically following the bond market. And the yield curve in the U.S. now is telling us to expect another easing in the not-too-distant future from the Federal Reserve, correct?
I would think so. I would think they're going to ease.
So
we don't have this chart here. We'll show it again next month, and we do show it in our client note that our clients will get over the next couple of days. But it shows the shape of the yield curve, the S&P 500, and past recessions. And this is exactly what happens. The Fed will be cutting rates faster than people think because they're playing catch-up, because they're behind the 8 ball.
And what does this tell us about the Bank of Canada? Because they seem to be ignoring what's going on in the yield curve here, because the expectations are that they may not lower interest rates.
It's a good question. Our rates in Canada are still below the U.S., number one. Our government, i.e. our government bond yield curve, as well, you can't really, you have to compare them back and forth, but our rates are lower here. But the bank has been talking fairly hawkishly, if you will, which means they have not rushed to cut rates like the U.S. Federal Reserve has. And that has a lag. Everything has lags. That has a lag. But more importantly, what that did do over the past few months is it strengthened up the Canadian dollar, and that tightens up monetary conditions in Canada. So there are two ways monetary policy can be enacted. One is through the currency, and one is through interest rates. Because the bank didn't cut interest rates, our currency strengthened. That in itself was a tightening of monetary conditions in Canada. Then you have a lag effect, number one. And number two, I doubt very much the U.S. sees economic weakness / recession, and Canada doesn't feel the exact same pain.
Excellent. Okay, let's move on to our portfolios. Didn't see a lot of activity over the course of the month. Again, this is my portfolio, and it may be different from our clients' portfolios because my wealth forecast and my goals may be slightly different, so I may have different allocations. But for the most part, the one thing I did notice that there was some addition to the high yield bond portfolio holdings. Paul, anything you want to comment upon?
Yeah, just just last week we bought a new issue that came to the market, and we bought an okay weight in it. It's actually a very highly rated bond and a very defensive bond. So although it's a high yield bond, it's the highest rating in the category. So it really is more like an investment grade bond. It's a telecommunications company, Videotron, which is a operating subsidiary of Quebecor. So they are the Rogers of Quebec. It's a very big liquid bond. They just issued 800 million of it. It yielded us 4.5% at new issue. It's trading a little bit above par, or 100 cents on the dollar. So it's roughly got a yield on it of just below 4.5%. So we bought, depending on the client, but we bought roughly a 2.5 to 3% weight in that bond, I believe, and it just adds a little bit of value to our portfolio in a very low-risk defensive way.
Okay, great. Thank you for that update. And one thing we've been talking about, and you talked specifically with regards to our high yield mandate, but nickel prices are something that you keep an eye on, and for good reason. And I thought maybe we'd just take a few seconds to talk about why.
Sure. I'll be pretty brief with it. We do own a bond in our tactical model, a high yield energy bond, or pardon me, a high yield bond that actually has exposure to nickel, cobalt, and energy. It's Sherritt International. And nickel price, this bond is actually quite distressed right now and has moved up a little bit over the past month. But the price of nickel, as you can see here, over the past quarter has shot up enormously. We're up darn close to 50%, and it seems to be hanging out here the past month in this 17 to 18,000 range. We are meeting with the new chairman of Sherritt and another director on the board. We have been in constant contact with the management team and a couple board members. But this time we're meeting with the new chairman and another director, as I mentioned, to get a little bit more aggressive with how we think Sherritt should be operating with this newfound cash flow that will be rather substantial that comes from the price of nickel increasing the way we have seen it over the past quarter. So the cash flow produced at this nickel price is huge. And we just want to make sure they're going to do the right thing with the bond we own. So we're getting a little bit more aggressive or active with the management group or the board. So that we're meeting with them on October 28th, so at the end of this month. In the meantime, there's a lot of optionality in this for sure.
So maybe by the time we have our next meeting, you might have some further report on Sherritt.
Yep, should.
Excellent. All right. Well, thanks everybody for tuning in today. As Paul mentioned, it was quarter end, so we are working diligently to get our quarterly reports out to you. That should happen over the course of next week. If you do receive and have any questions whatsoever and want to talk to us, please do not hesitate to get in touch. We are here standing by. We are available and want always to be just a phone call away if you need us. So please make sure that you're in touch. But as I said, that's it for this month. So hope you all enjoy the month of October, and we look forward to getting back together at the beginning of November. Until then, on behalf of Paul and Bianca, I will wish you all a great rest of the day.